All right, we are live. Okay. All right. All right. So, hey guys, welcome back. Welcome back. Welcome back. So, this week we're going to pretty much build upon the main course of topic that we discussed, or the main concept that we discussed last week, which was the builder's profile. I introduced the builder's profile to you guys. Um, and what the builder's profile is, for anyone who may not be aware, it's a step-by-step guide on how to build credit without the gimmicks, without the hassle, without the guesswork, eliminating all guesswork. Literally, I walked you through step by step on how to build credit, how to do it efficiently, and how to do it effectively. So basically, if you are a person that just are stuck on how to build credit, you've been told, you need to build credit, but you don't really know what you're doing. You probably have added accounts and just random things to your credit report trying to build credit, but like wherever you are now is just not where you know your credit profile should be, and you are just stuck between fully understanding what you need to add to your specific profile, what you're missing, or even just like identifying any areas of opportunity that you can add to your profile that'll strengthen it, right? And so that was last week. That's called the builder's profile. And today we're going to build upon that, but I wanted to discuss something that I don't feel is talked about enough. And also just show you guys a little more of how lenders are viewing your credit profiles, how they're viewing your credit applications, and what is leading you to those perpetual low limits, denials, constant low tiered approvals, and things of that nature, like high interest rates or higher interest rates than what you feel as though you deserve. So today we're going to talk about that in a lot more detail. So I want to pull something up really quick. So let's see. All right, here it goes. All right, so this is what we discussed primarily last week, which is, like I stated, it is the builder's profile. And so for anyone who may have missed that live, still want to understand what you need to do, what you need to add to your credit profile in order to build it in a way that lenders prefer, in a way that lenders will approve it, then go back and watch the last live. We're not going to go over everything that we talked about in the last live, of course. But it is very thorough, and it is step by step. So it's taking all of the guesswork out, all of the gimmicks, all of it, right? All the mess. Go and watch that if you still are unaware or unsure of how to build credit. Okay. So today we're going to talk about what I call the credit repair trap. The credit repair trap. And what the credit repair trap is essentially is just that area or that position that people tend to end up in after they have either tried to repair their credit themselves, hired somebody to repair their credit, or just have been on a credit repair journey for years on end. This is something that I've noticed throughout my experience and been in this industry. I noticed that there's always like it's like I'm just gonna call it arena, like a familiar arena that most people will fall into, or a trap. I'll just say most people will fall into as they're pursuing credit repair, and it always brings them to hitting a wall or facing a wall. Maybe your credit score has increased 100 points, maybe 50 to 100 points, or even more. Maybe maybe you just are not getting approved for quality offers. Maybe you cannot increase your credit limits and things of that nature. And you're just like wondering, what else is it going to take? Like, I've repaired my credit, or I'm, shelling out all this money to fix my credit, but nothing is working. Nothing is working. And so today we're going to discuss the credit repair trap, as I just stated. So, number one, why the deletions that you may have received or are maybe contending for currently. Let's first talk about why they're not exactly what you hoped for. Most people, when they start to repair their credit, they obviously are hoping for as many deletions as remotely possible. Most people want to remove the old student loan account, remove their charged off account, remove the collection accounts, and remove every account that they perceive to be a threat. I mean, a threat to where, to good credit, right? Like you're gonna look at your report, you're gonna see late payments, you're going to see the student loan that you may have not started paying back yet. And you're like, I need to get this account off by any means necessary. And hardly is it ever the case. Not that that's not true, it's just not complete, right? It's just not complete. And so you typically fall into this trap after you've exerted all your effort and money and your finances and your resources in order to fix your credit, because you are convinced, or you have been convinced, that repairing your credit is the only route to good credit. And so today I wanted to speak to that and show you, like actually show you why that is not the case, and also what lenders are evaluating your credit profile on, right? You guys, if you are not new here, you've heard me speak to the idea that your credit profile is way more important than your credit score. I will say that to my dying day, because that is just a fact, right? But that's also, as I was thinking this week about what I wanted to talk about for this week's webinar, I was really, really, really focused on the credit repair trap, right? But also focus on those individuals who are willing and open to fixing their credit, but they just are still unsure. Last week we talked about building, right? Like what you need to do and what you need to add to your credit profile in order to build a quality, great profile, right? Now that you know how to build, I now want to talk about the whys behind it, and also bring you guys behind the scenes of like what lenders are, like I said, evaluating your credit profile on. Okay. So here's the hard truth: deletions does not equal elevation. And we can just stop there. Honestly, we can really just stop there. And that pretty much summarizes the entire live tonight, which is, whenever you do get deletions on your credit profile, that doesn't automatically equal or equate to having good credit, right? We will focus all of our time. And by all of our time, I mean, like, there are many people who are refusing to build credit, refusing to apply for certain credit products, because they feel like, well, I just need to get this one account off. I just got one more account that I need to get removed, and then once this account falls off, then I'm just going to start building credit. Or never fails. I hear, I can't get the credit card that I want right now, or I can't get approved for a credit card, so I'm just going to wait and continue to send out these dispute letters and try to challenge my credit report, and hopefully, that account gets removed. And so there's this like waiting that kind of happens, and mentally, I feel like, with people when they don't see a perfect credit profile, um as a result of their disputes. And then on the other hand, on the other side, there are individuals who maybe are frustrated because they can't get a deletion. Maybe they've been challenging a charged off account, and the original creditor is constantly validating and verifying the account, so it's there on their credit report. It's stuck, like there's nothing the credit bureaus are doing about it. And then there's a frustration that has been, developed within you, and then you are either going to give up altogether on your credit and just say, whatever, I'll just wait the 7 years, or you just really start to believe that your credit is never going to improve. Like, I see that both of those positions, like, on a daily basis. And so that's why I wanted to definitely speak to that. Now, deletions doesn't equal elevation in terms of your credit, because it is not about what's removed from your credit report. That's not what good credit is. The absence of negative accounts doesn't equate to good credit. The only thing that equates to good credit is building good credit, right? And so that's a process that you can't skip. There are two separate but co-equal processes when it comes to improving your credit. You either have to repair your credit, and then there's a building your credit, rebuilding or building your credit, right? And what happens when people are typically only focused on the repairing of their credit, they tend to just look over, or really don't pay much attention to the building part, and then they wonder why so much time has passed, so many resources has been exerted, and they're still maybe not in square one, but perhaps square two, right? They're still not where they want to be. They're still not where they want to be. Because deleting negative accounts removes evidence of your past behavior. So the collections, the charge-offs and stuff that you're getting removed, those are gone, right? If you repair your credit and you get the deletions that you hope for. But that does not add new evidence of improved behavior to your credit profile, which is ultimately what lenders care for. That's all they want to see. That they want to see. The- It's not the it's not you having negative accounts on your credit report that is which is let me rephrase that. It is not the only the negative accounts on your credit report on why you can't get approved for the credit limit that you want, the trade line that you want, the home, the car, the card, right? It isn't because you don't have negative accounts, right? What primarily will decide if you are going to get approved in all aspects, no matter what you're applying for, is the structure of your credit profile, which we, like I said, went over last week. But also, you got to be very keenly aware of how lenders are seeing your profile versus how we as consumers see it, because it's a total different picture. It's a total different thing that they're looking for. And I really want to drill this in because I feel like it'll help mitigate a lot of the frustration that comes with credit repair. Because it's like people will be stuck in credit repair for years, and that is not a true credit repair journey. And I am a person who is in the credit repair space. I own a company who helps customize your credit repair ladders, and it would help my bottom dollar to just get on here and say, "Yeah, y'all need to repair your credit. Y'all need to do this." But that's not the truth. That's not the truth, and I've never stated that or claimed that ever, and I won't ever start. The point being is you can pay somebody to repair your credit, and then you still aren't going to have good credit. Money, you just shelling out money to pay somebody to repair your credit, you sending dispute letters on your own behalf, that's never going to get you to the finish line ever. It can help assist you, it can give you a little boost, but that's not even half of the picture or the goal that you should be after. Credit reports evaluate what's present and not what's absent. Okay. So again, the absence of negative accounts doesn't equate to good credit. Even if your score went up, because that's the thing. Of course, your score is going to increase most of the times when you get removals off your credit profile. But your borrower worthiness, which is the framework that lenders use to evaluate how much you qualify for, what you qualify for, and at what cost do you qualify for that thing, that's always going to be determined off something much deeper than just your credit score, because the numerical value of our profile is called our credit score. And as consumers, we look to our credit score to determine if we have good credit or not. The 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 thing about that is lenders are not looking to our credit score to determine if we have good credit. Lenders are doing the inverse. They're looking at our credit profile to determine if, number one, does it is it suitable for what our credit score is claiming to represent? Does our credit profile live up to what our credit score is claiming? Most of the times, I'm just going to be really honest with you guys, more than half of the times, and I would probably even say like maybe 70% of the time, no is the answer. Most people who have a high credit score or good credit score don't have the credit profile to back up the credit score, right? And that's why they're still not able to get approved for quality offers. When I first got in this industry, like around 10 years ago, the goal was always at least get a 750 credit score and you're good to go. Like you can get pretty much whatever you want to be approved for at a 750. I even named my company Road to 750. In my ignorance, as I was trying to learn about credit and all of the nuances of it, I was thoroughly convinced that once a person gets to a 750 credit score, then they're good to go. But throughout my experience and as I've dealt with multiple different credit profiles and issues and all of that, lenders and seeing their side as well, I've now come to realize that not only not that that's not true, not that a 750 credit score shouldn't be like, an overarching goal, I guess, for most people. It's just not complete. It just wasn't complete because I have seen many credit scores, many 750s can't get approved for a $10,000 credit line. That's not good credit. I've seen many 750 credit scores can't get approved for American Express or something like that. And it's like, that's not good credit. You have a good credit score, but your credit profile sucks. Your credit profile sucks. Not only your credit profile, what is the indications and the signals that you're sending to lenders? And we'll go over that today. But real quick, just for the novice watchers who don't really know the behind the scenes or how our credit score is broken down, I typically like to mention this in every single live, just so that we're all on the same page. Okay, so number one, our credit profiles, our credit scores rather, our credit scores are broken down into 5 categories. I go over this all the time. The first category is our payment history. That's 35% of our score. Payment history on its own is worth 192.5 points. Okay, the problem with only repairing your credit and not building, when it comes to the payment history portion of our credit report, in order to gain those 192.5 points available, you need active reporting accounts with consistent patterns over time. So unless you are actively building credit, then you are not getting nearly, if any, of those 192.5 points, right? And so you literally can't build payment history based on just like only worrying about deleting accounts, because honestly, a lot of the accounts that y'all be getting deleted, it may have had 3 years of positive payment history, and perhaps at the end of that loan or whatever it was, it may have went bad. Maybe it was charged off. That was still 3 years of positive payments, data points that was profited to your profile. So you were still gaining points off of that, right? Um, and then the next section is credit utilization. Right under payment history, credit utilization is 30% of our credit score, and it's worth 165 points. You know what you need in order to obtain those 165 points? You need an active reporting credit card, multiple, right? And unless you build credit, you are not going to be able to gain or obtain any of these credit utilization points. None of them. So if you just deleting the charge offs, the student loans, the bankruptcies, and all of that, that doesn't solve the issue of still needing to have 30% of your credit profile dedicated to actively reporting credit cards, right? Um, you can't demonstrate utilization management without credit cards reporting balances. Even your closed credit cards, they're not going to give you what active credit cards will give you when it comes to credit utilization. Literally over 80% of those 165 points are dedicated solely to open accounts, open credit cards specifically. Okay? So you just if the second that you decide, I don't care where you are in your credit repair journey, the second you decide that you are not going to open a credit card, then you are willingly giving up 30% of your credit profile. Willingly, right? Um and then credit age, which is the third largest factor in our credit scores, that's 15% of our credit profile. That's 15% of our credit score, and worth 82.5 points. Okay. So those 82.5 points, the only way you're going to get that credited to you is if you have seasoned accounts with long reporting history. I keep stuttering. But anyways, unless you have seasoned accounts that you've allowed to age and build credit age, right? Then you're not going to ever get any of these 82.5 points. So again, just reinforcing the same idea. You still need to build credit. You still need to build credit. Empty credit, clean credit is no better than bad credit. It's really not. You're on the same level in terms of how lenders are viewing you. Well, we'll get into that. All right. Now, deleting accounts destroys credit age, because every single account that gets removed from your credit report will take away from your credit age. Every account on your credit report, no matter how old it is, no matter what the conclusion of that account was, if it's charged off, if it's in collections, doesn't matter, right? Everything everything has an age. Everything has an age attached to every account has an age rather attached to it. So a lot of times when people are repairing their credit and wanting to get deletions, they will tend to decrease in credit score. Like your credit score will tend to decrease as a result of getting things deleted and removed off your profile. But that's simply because you lost credit age, right? That's all that was. Which goes to show that in order to, if you're trying to add the credit age back or even just build credit age in general, you have to have accounts on your credit report. Doing a credit sweep and all of the mess and stuff that people are recommending nowadays, that isn't good credit. And it pains me to see people so focused on repairing their credit, and they're not as equally zealous about building credit. Because I know for a fact the second that you have that thought that you need to repair your credit before you build, or credit repair is the only way out, I know for a fact that you have only ever perceived your credit report from a consumer's point of view, or from other people, rather than truly understanding what lenders want, what lenders are looking for. They're the ones letting you borrow the money, not the people that's flossing credit scores on freaking TikTok. They not lending you no money. So it's cool. It's they list, you can, obviously there will be some sound advice. Cool. My point is, if you are solely basing your credit profile off of what other consumers are saying, then I hope they gonna lend to you. I hope, like, because that's not what lenders want. It's just not what they want, and that's really just it. And then the last area that I want to touch on of our credit profile is credit mix. This is the fourth factor to our credit scores, and it's 10% of our credit scores worth 55 points. So this credit mix just means, like, you can demonstrate on your by way of your credit report that you are able to diversify, or you have diversity within your credit profile. You don't just have only credit cards. You don't just have only installment accounts. You have a mix. Like, you have a mix, and you're able to demonstrate how you maintain credit from different lenses, from different aspects, in different accounts with different financial institutions. Y- you are what's called you are what's said, like, a diversified borrower, right? They want to know, lenders want to look at your report and know what is the likelihood of you defaulting on whatever credit product that they are offering, based on the current experience, or the level of experience that you have dealing with that type of account. So if you don't ever showcase experience on how you would behave with a credit card versus a loan, then you cannot expect for credit card providers or banks to trust you solely based on how they see that you're behaving with a loan. Because that's another problem that I see a lot of times, for some reason, and I don't know the connection, but I do find this a lot, where it's like people will be repairing their credit is improving, and then they tend to base their entire credit profile on, like, an auto loan. It'll it, or I tend to hear, I've been paying my car note on time for 3 years. Why don't I have good credit? And I'm like, well, because you have empty credit. Like, that doesn't show them anything. You behaving on one account, that's nothing to lenders. They don't care, right? Well, they care. They just want you to add more to it. All right. So what deletions, erases from your credit profile? So outside of obviously erasing the bad, negative account or derogatory information from your credit report, it also will erase payment timing patterns. So how consistently you've paid this credit card or on this account over the months and the years. It'll erase that. Whenever you get an account removed, everything and every single data point on that account is also removed from it, right? And so once it's removed, then lenders are no longer able to see how you historically manage the balance on that account, right? The how long you was with the bank, what's the longevity of the relationship that you had. Also, one thing that's not talked about enough is the credit behavior evolution. The best way I can explain this, and it's really simple, but it's just essentially them seeing, are you showcasing, as per your credit report, a learning curve. There's a learning arc. You perhaps have messed up your credit in the past. You had a few bad accounts, a few things went to collections, maybe you had a few things charged off. You are not able to show any learning curve or even learning arc if you do not come out on the other side of that showcasing behaviors opposite of that, right? So yes, like I said, in the past you may have had the bad credit. What are you showing them right now, currently today, that they can base their decision on, that's not your past? Because if you just erase everything on your credit report and all of your history because it just wasn't favorable to you, then they don't have anything to base it off. They don't have anything to base it off. Bad credit, derogatory accounts rather. Bad credit is only bad credit is only bad credit if you don't have good credit to neutralize it. Like, literally, that is all that credit is. You are not penalized forever for having a derogatory account. This is why perfect credit scores are not even a thing. They're a thing, meaning like it's, I guess, possible to get it, but like maybe 2% of the population has perfect credit there. And you think lenders only want to lend to the 2% of the population? Absolutely not. They are a bank at the end of the day, or they need to make money. That's not the like that's just not the truth, right? You don't have to have perfect credit, meaning you don't have to have a scotch free clean history in order to have great credit. Like, really, you don't. And I'm not talking about the credit score. I'm talking about your profile. What actually matters. And so then another thing that I wanted to talk about when it comes to the credit repair trap is the missing data problem. Now we're going to talk about things from a lender's point of view. As I stated, I wanted to bring that view into the conversation because I, number one, believe that that's the most important viewpoint, but also it's important for you as a consumer to understand this. Because like I said, y'all be building for other consumers and they're not the ones that's lending you the money. The banks are, the lenders are, right? And so there's something that's called the missing data problem, right? Missing data, rather. What missing data is overall is basically, this is what happens whenever a person starts to build credit. What's this year? It's 2025. So let's say you are a person, I'll use my age because it's just easier for me to compute right now. So I'm 32 years old. I started my I got my first account, which was a student loan at 18. Okay. So over all of this time, it's been how long? Oh, dang, wait. It's been 12 years or so. Yeah, something like that. 12, 13 years, right? So over the course of this 13 years, from the time that I first started building credit to right now, there is a story to be told, per se, on my credit profile, meaning like it's very clear looking at my profile that you're going to see some now closed accounts that was like a $300 credit card. Loans that I've had in the past, even my first car loan, which was a 28% interest rate. And then as time went on, there were accounts that I opened and closed throughout this 13 years of building credit. Okay. When a lender pulls my credit report right now today, they are not just seeing Lashonda with the 800 credit score and the now financial responsible habits. Like, that's not the only thing that they're seeing. What they're also seeing is, again, like that storyline. They're able to trace it back to see there was a time where she has had bad credit, questionable credit habits, questionable financial behavior. And throughout this time, maybe they'll be able to, draw a line or see a trend where I started to fix those habits. I started to showcase the correct behavior. And then that's where, which is what I call like the arc, like the learning arc, that's where that's where they start to base your future decisions off of. Only if you haven't reverted back to the old behaviors, right? So as long, like, if you have bad credit, as long as you are able to show an arc where you have learned a learning curve and you have learned, and then you left behind those bad habits, then a lender is never going to hold the old past behavior against you, right? But the missing data problem, and it's very pertinent now, especially with our new credit scores, especially with our new credit scores. This is what I want you guys to realize. FICO FICO has a creation date in terms of whenever you started building credit. For those of you who don't know, in order to even generate a FICO score, you have to have at least two accounts for 6 months, and then in some cases, like as long as you have had at least one account report to all three credit bureaus for at least 6 months, then they'll generate you a credit score, right? So they have what's called a creation date, which is to mark when you started building credit, right? Now, our credit report only houses up to 10 years of information, unless the account has just been open for longer than 10 years and maybe it's a credit card and you've had it since whatever, right? That'll be available on your report. But in terms of what lenders can see and pinpoint, pretty much the last 10 years, right? What happens is, if your creation date is, let's just say for me, it was in 2011. So my file creation date was in 2011. That's when I first generated a credit score, meaning that I had an account in my name at that point. If there is gaps of years of information where in 2000, if I started building credit in 2011, and then maybe from 2016 to 2021, there is no activity reporting on my credit report. There is gaps of missing behavior or missing information, missing reporting. And what lenders will do with those gaps, number one, it's always a red flag to lenders, because they already know that typically means that you've either done a credit sweep or just mass deleted all of your accounts, right? And so when you have so many of those missing gaps in your credit profile, and you never ever fill in the gaps with actively building credit, then lenders are going to just throw your, not technically, but they're going to throw your credit report away and cause you to be stuck at a credit tier, which we'll talk about, that will never equate to what your credit score is showing you. And this all happens behind the scenes internally. This happens internally with the lenders. So you missing chunks and chunks and gaps of information because you're so concerned about deleting all of the bad information on your credit report that you don't even realize that you're also sending bad signals to the lenders, and they're still and what they can't, what they can't see, they're going to assume, and it's never going to be assume what's best, the best case scenario ever. No, because the whole point of lenders and our credit reports is to demonstrate our risk factor. How risky, how much of a risk am I as a consumer of going default, of not paying the lender back, right? That's all they want to see. They're evaluating your risk score. It's not your credit score. They want to know how risky you are. And to determine how risky you are, they look at your past, and then they also look at your present, and then to determine your future. That's it. That's really all that's to it. So when you have those missing gaps of information where they're not able to see behavior patterns, there's no data to how you respond. You don't have any credit card on your credit report that has never been increased. So the original approved credit limit is still the same limit that's currently reporting today. Always a red flag. Because what do I constantly tell you guys? We should never normalize not getting credit limit increases. That is the point of credit. So you getting a credit limit increase shouldn't come as a surprise. That is a byproduct of being a trusted borrower. Multiple times a year you should, right? So when that does not happen, then that's the number one indicator that you need to understand, that means that you are not being moved up tiers when it comes to how lenders are viewing your profile. And then you have to ask yourself why. But I don't want you to try to guess the solution or guess the answer, because we're going to go over it today, but this is a real thing. And then another thing is stress testing. No evidence of performance during economic downturns. Let me tell you guys something. Whenever, I'm sure you guys have seen it or whatever, know what I'm talking about. There is indicators on our credit reports that can pop up that we as consumers can see when it comes to either economic downturns or national emergencies or whatever, right? And so you'll have a note pop up on your credit report if you were affected by a national disaster, and it'll say something along the lines of national disaster. It'll put a national disaster alert on your credit report. Are you guys familiar with what I'm talking about? Or do I need to try to show you? If you've ever been affected by a national disaster or something and your account was potentially affected, it'll be on there. Y'all don't know what I'm talking about? Okay, while I try to find it, I'll continue to explain. Try to find an example of it. All right. So when that happens, whenever you get the national disaster, I can't do two things at once. Hold on. All right. So when you get the national disaster indicator on your credit profile, what a lender, that's there to help you, but only if, like I said, you understand what they're looking for. But anyways, whenever that pops up on your credit report, and I'll find an example because I don't want to get off track, but whenever that pops up on your credit report, that's just literally telling the lenders or communicating to the lenders that there was something that happened outside of your control that may have affected your behavior on this account. Okay. As a consumer, that's one of our rights when it comes to the FCRA. And I guess that's their ideal of giving us grace during again national disasters or economic downturns. That's a real thing. So I'm bringing this up only because COVID was our most recent example of this, except COVID isn't something that we see as consumers on our credit profile, you're not going to see the national disaster rating on your credit profile as a result of COVID. But the reason why I'm bringing it up is because the lenders all have deemed that an economic downturn. Markets were down. Everything was down for a while, right? And the point being is whenever you are applying for credit right now today, because that was the most recent national disaster that pretty much affected the whole United States or everyone, they're always going to go back to that time, and you are going to be either attributed more points for how your credit profile behaved during that time, or there will be points taken away from you based on how your profile responded to that time. Why? That's not fair. Like, what's the point? I get that. The point is that's called a stress test. That's a stress test. How were you during the last economic disaster that affected your profile, right? And how did you respond to that? Did you start missing payments as a result of that? Um and let me rephrase what I just said. Actually, I just realized that I was in error a tad bit with what I just said. If you responded graciously to that and you still continue to make your payments and all that, then points are attributed to you. However, because the national disaster is a grace filter, it is a neutral rating, then if you did not respond positively to that, then you're not dinged points. I'm sorry, I should have cleared it up. You're not dinged points. It essentially just becomes neutral. The point is, if you did respond positively, then you do get a little boost. You definitely get a boost when it comes to how you responded. Does that make sense? Like, it doesn't affect your score if you did not respond in a way that maybe is responsible, deemed responsible, simply because that is literally what the entire consumer right is about, which is if it's outside of our control, we cannot help it. So you're not dinged for it. However, you certainly, if you responded rightly, then you will be boosted for it in terms of your um just how much your borrower, your risk factor, it goes down, because if they can see if they can see that you responded in a way that they would approve as per the last economic disaster or national disaster, then they can only expect that if it happens again or something alike happens, then you'll respond the same way, right? So when you remove everything from your credit report, you don't give the opportunity for even your past, what you may have viewed as bad credit or derogatory information, to help you in any way, right? Another thing, your relationship debt. We talked about this really heavily on the last live, so I don't want to like get back into it. But when it comes to like your banking relationships, how long you've been able to be with a bank for checking and savings, but also like it is always a red flag if you don't have any demonstrations of on your credit report of being with a single bank or financial institution for more than like 3 years. 3 years is like the bare minimum. That's always the honeymoon stage, the beginning stages. But after 3 years, if you cannot maintain banking relationships outside of that, after that, right? Red flag. You are risky to lenders, right? And then just like your usage consistency. So because you erased everything, they're not able to surmise any patterns of what is regular or responsible credit usage to you. According to your life, pertaining to your profile, they're not able to see what's your average um amount that you spend in a month when it comes to your credit cards, right? Then they're not able to even give you a good credit limit increase if they're going to offer one, because they don't have any baseline. They don't know they don't know you, right? And so it just affects it affects all those areas. But now let's talk about the consumer's view versus lenders, okay? In terms of when you repairing your credit, when you are removing these accounts, doing the credit sweeps, or perhaps just stuck in your credit journey, right? Whenever someone repairs their credit, most people will see they have a higher credit score. So they think, oh, I'm in there. My credit score is higher. Certainly, I shouldn't have an issue with getting approved for this credit card that I want or this credit limit increase that I want, right? You'll see that you have a clean credit profile. So you don't have any more derogatory accounts. So in your mind, you like, oh, I'm good to go. I should definitely, by the next time I apply for something, I should get approved for it. No, like it should not be any struggle, right? And then another thing that folks tend to believe is like after a few approvals, that, perhaps they're proud of. Maybe the Capital One accounts. Maybe it doesn't matter the company. I'm just saying you get a few approvals that perhaps you were not qualified for at first. And so you start to believe that like you're in complete right standing with the lenders and you should be able to get whatever you want after that. And that's just not the case. That's all consumer lenses. Like literally that is how a consumer views credit. Whereas what really happens is from a lender's point of view, what happens is banks and lenders are always reading your behavior much deeper than your credit reports. They don't care about the credit increase, the credit your credit score increasing. They don't care about the fact that you cleaned your credit report. They don't care about the few approvals that you have on your credit profile. That's not what they base it off of. Instead, what actually happens is 99% of lenders will have some sort of automated internal lending systems. We know this because anytime you apply for a credit card, anytime you apply for any credit product, you know that it's going through a automated system. There's not a human that's specifically viewing your credit report and determining if you're going to be approved. Very rarely. And even the ones where maybe a worker, whoever is actually viewing your report, the underwriting system is all automated and it's all internal. I mean, it's based on um an automated internal system, right? If you are in a mortgage industry or just in the financial industry, you may have heard of some of these internal systems. But just to briefly go over them, these systems evaluate your application, your credit application based on your credit profile structure, your credit history, and also the behavior that your risk indicators or your credit indicators are communicating to them. It's never based on your feelings. It's never based on how great of a person you are. It's never even based on you having disputes or not, or even the mere absence of negative accounts. That's not what these internal systems are made to read and evaluate your credit profile on or your credit application on. Instead, things like the desktop underwriter, which is pretty much what they use in mortgage lending to get your credit score, lender logic, and all of that. And then trended data. These are trended data is our newest credit score. So our newest version of our credit score rather is called FICO 10T, and the T stands for trended data. The trended data specifically is a pioneer when it comes to how our credit reports are going to be evaluated going forward from here. Simply because instead of tracking like static data, so like if you apply for a credit card right now, well, let me rephrase that. If we're going off our standard credit scores, which is before FICO 10T sort of taking a hold, it was FICO 8 that was like the main credit score that most lenders pulled, right? And so how it worked under FICO 8 is if a lender pulled your credit application, they're able to see the static data of your credit profile, meaning like whatever your balances was, your usage was, according to that date. It's like a snapshot, like it's still in time, right? They're not able to see a running data or running trending at all when it comes to how FICO 8 views your report, how lenders are able to see your report. Under our new under our new credit scores, which is FICO 10T, they're now able to see trended data. So literally for every single account on your credit report, they're able to see a 24-month history of that account. Every single thing that's happened with that account, every balance that you have reported on that account, they're able to see any account status variations. Did the account go from open to close or default or whatever, right? Like they're able to see the full history going back to 24 months on every single account that you have on your credit report. So that's just trended data. So they're getting much more information than they ever have before. And this is now, like this literally started in 2025 and it's only going to get more popular. Experts are predicting that by the end of this year, that if not all, most over 90% of lenders are going to pull FICO 10T just because it serves the lender way more. It serves them way more, right? The point is now because you have to worry about trended data, this is more of an important conversation than it ever was when it comes to me wanting to stress to you guys that it actually matters what's on your report. Of course, you knew that, of course. Not only that, it also matters that your history, that you have some history there. Not all bad credit history is worthy of deleting or removing. So again, if you think that just because you have the charge off, just because you have the collection or whatever the case may be, that you can't build credit, that's false. That is false. That's a lie. That's a lie. Um, but I want to get to these lender tiers. All right, so the score versus profile mismatch. The score versus profile mismatch explains why people with good credit scores, high credit scores, still get denied for products, while others who may have a lower score than them will get approved. And I'm going to save this to the end because I just want to get to the profiles because I want you guys to see this. All right. So let me explain what these lender tiers are. Lender tiers are a hierarchical system that's used and built into all or most of the internal automated systems that lenders use in order to evaluate our credit reports, right? Meaning anytime a credit application comes into whatever company that you are applying for, there is a level, there's a tier that your credit profile is assigned to. The system that it goes to, the automated system that it goes to, automatically assigns your credit profile to this tier, right? And so when it assigns it to this tier, your borrowing ability, however, whatever the lender is going to approve you for, and at what cost they're going to approve you for, that is always going to be within the confines of what this tier will allow. Okay. Does that, I hope that makes sense. I try to explain it in the most simple way possible. If it makes sense, press a one, because I don't want to keep going if you guys, perhaps are still confused on like what these tiers are and what we're about to get into. While I take a drink. How, okay, okay, good, cool. Okay, so your credit profile is right now today assigned to one of these levels. And as we're going through this, I want you to start to number one, be honest, but start to familiarize yourself with or recognize which level perhaps you may be on. And there are always going to be signs and indicators that perhaps this is where your profile is signed. And my hope is it will open your eyes to where you currently are, and so you understand what you're missing in order to get to that next level. Okay, so these levels, these tiers are pretty much broken down into five tiers. And an overarching view is level 0 is going to be reserved for, or tier 0 is going to be reserved for the damaged or derogatory credit profiles. These are going to be, well, I'm gonna go through them separately in a second. So level 0 is going to be for your damaged or derogatory profiles. Level 1 is going to be for the repaired credit. Maybe you don't have as many deletions, but it's thin. You have thin credit, you don't have many accounts, and maybe all of the accounts you have are considered subprime. And then level 2 is going to be building or intermediate credit profile. These is going to be the credit profiles where you can clearly see that they are actively building credit, but maybe their credit profile has not aged as much as lenders would want, but they have a great start. They're off to a good start. And then we have level 3, which is prime and established credit profiles. And then level 4, that's like the strategic wealth credit profiles. And we'll go through each one as I stated. But okay, I thought I was going to switch to the next. All right, so the first level we're going to discuss is level 0, which is the damaged derogatory credit profile. The risk category for this credit profile is typically very high default risk. So if your credit profile is assigned a level 0, then that means that you have the highest risk rating available. So that also means that your credit score is typically ranging from about 400 to 580. Not always, because as we already discussed, credit scores are not always matching and accurate to the profile. But just to sort of give you guys a better view and so you can understand it, I wanted to still include like a typical range, right? So don't just be dead set to the credit score, right? So typically the 400s, honestly, I could have went all the way down to 300s, but like 400s to 580s are typically being rated a damaged or derogatory credit profile. Now, what does this credit tier or credit profile typically look like? these are going to be the profiles that have recent collections, recent charge-offs, or recent bankruptcies. Just so you know, lenders consider recent when they use that word recent, they are literally referring to anything that has happened within the last 24 months. Okay. Some lenders will only coin recent as the past 12 months, but the point being is it could be within the last 24 months, right? These typical profiles, these level 0 profiles typically don't have any positive open accounts, or maybe if they do have any positive opens, they have like one positive account or so. You typically it will be difficult getting approved for basic products. So if you can't get approved for like the traditional Capital One cards, Discover cards, it's probably because this is where your credit profile is landing in terms of according to lenders. Or that I repeated that. And if you just filed bankruptcy within the last 2 years, if you have like active tax liens, or I put or wage garnishments, but only if that was caused by like a federal debt. So I just still wanted to include it. Another thing that can land you on this tier, and what we talked about last week, was your banking relationship. Your banking relationship. So that means that even if you have good credit, even if nothing else on this credit profile looks like yours, relate to your credit profile, the very fact that you don't have a standing strong banking relationship can place your credit profile in level 0. It doesn't matter how long you've been building, how long you've been repairing credit, how many accounts you got removed. You can still be placed on level 0 simply because of a banking relationship, which is why the banking foundation was so important when we talk about building credit. And if you are confused on what I'm talking about, please go back and watch the last live, which is how to build credit without the guesswork or the gimmicks. Um Internal lender markers when it comes to level 0. Um, these files that are on level 0, systems will flag these files as very high risk, as I stated, and this is before any human interacts with your credit profile, even sees it, even blinks at it. Like, that matters none. By the time by the time a person sees your credit report, it's already been graded. It's literally already been categorized. And the person is only able to do within the confines of the tier that your credit profile has been rated on or graded on. Okay. Another thing is default. The reason why this is considered high risk is because your default likelihood is predicted to be over 60% in the next 12 months. So that literally means that a lender thinks that you have a more than 50% chance of defaulting on this account, or failing to pay this credit card back within the next year. So if they feel like you can't even make it a year um in paying them back, then you are extremely risky to them. Extremely risky. So this is going to naturally lead, of course, to lenders that don't want to approve you. You're going to receive a lot of denials when you're on this level, because there's nothing that you can do to get off of this level except build good credit. But that's a whole nother story. Another thing is past charge-offs with the same institution. There are some institutions, American Express, where if you charge off their account or include their account in bankruptcy, it can be very hard, if dang near impossible, to get them to approve you again, no matter how good your credit report is. And that's some banks. Some banks are just like that. Or sometimes they'll just kind of put like a 7-year ban on your social security number. So even if you do apply, even if you would otherwise qualify, because you have previously included their account in bankruptcy or charged it off, they'll say like, no, we're not accepting this application. Okay. And so to their system, your credit profile is going to be placed into level 0. Okay. Now, what you can access with a credit profile at this level, you typically can get the secure credit cards, where you have to secure your own credit line, $300, whatever. You have to take the risk. You have to show them that you're willing to take the risk with your own money before they trust you before they trust you with their money. Okay? These are going to be like the subprime cards. Some credit unions will still work with you, like Navy Federal is very forgiving. They'll help you to kind of start off and get, to start building credit and whatever the case may be, and other credit unions as well. But you're typically going to get the subprime car lending, auto loans, 15% or more APR, and things like that. Like this is what this credit profile will typically qualify you for. And then, like I said, you will have a lot of denials, because if you are applying to companies or for credit products that requires at least a level 1 or a level 2 in order for you to be approved, and your credit profile is coming through as a level 0, then they are not going to approve it no matter how much they like you. It doesn't matter. Um and then, so the underwriting approach, my bad. The underwriting approach in terms of how your credit profile will be underwritten with a level 0 credit profile. You typically, it's fully automated denials, and you won't typically be able to ask for reconsideration or things of that nature, or anything that comes with you contacting a real human and asking them to evaluate your profile. If you're on a level 0, you don't there's nothing that they can do about that. The only thing that they could do, I mean, the only thing that can be done about that is you get to at least a level 1, right? So, well, I'm moving ahead of myself because I wanted to mention something. And then income verification. I wanted to include that because that's a real thing when it comes to credit applications. And most people are under the belief, or maybe because they're so conditioned by their past approvals, that they believe that no matter how good your credit is, there will still be a long, extensive approval process and income verification and all that. That's just not true. When you actually build quality credit, not just your credit score, but when your credit profile speaks more than your credit score, then the income verification just doesn't have. I can't tell you the last time I've done income verification, and I'm self-employed. And anybody who know anything about being self-employed, lenders want you to show everything. But that starts to happen less and less the more you build your credit profile the right way. Seriously, it really, I literally cannot tell you the last time where I had to go through like this whole process of getting approved. It's just like, no, my credit profile speaks for itself. I don't just have an empty credit score. My credit score isn't just high because I piggybacked off someone else's credit card or whatever the case. It's not falsely inflated in any way because my credit profile um substantiates it, right? And so, if you find yourself on this level, if any of those things that we mentioned on level 0 sounds familiar to you or to your credit profile, then your focus should be getting positive accounts opened and making perfect payments. And when I say perfect payments, I mean not only going out there like trying to, get rid of your last or past late payments. No, you need perfect payment, which is a full year, 12 months of not being late on anything on your credit report. I don't care what that means. Even if you got to pay the minimums on your credit cards, it's not the best case scenario, but it certainly is better than getting a late payment, right? You need to your response to bad credit, negative credit should always be perfect payment history. And banks don't consider nothing perfect. They don't consider your payment history perfect unless you have gone 12 months. Your most recent 12 months does not include any late payments. Okay? So that means if you had a late payment 2 years ago, they definitely see it, of course, right? I'm not going to pretend that they don't. Of course they do, but they will still see, they will more and base their decision on, rather, the fact that you've gone 12 months and nothing on your credit report has been late, right? Nothing on your credit report has been late. In fact, I want to go a step further to say that if you are on level 0, if your credit profile is qualifying for level 0, it means that you have late payments within the last 12 months in some form or fashion, whether that's a collection, a charge off, or just regular late payments, bankruptcy within the last 2 years. Those are the big factors that will qualify your credit profile for level 0. Okay. Now, if you are on level 0 and you are trying to, okay. If you are trying to get to level 1, what's missing from your credit profile in order to get to the next level, which is level 1, is going to be having at least one positive trade line reporting for 6+ months within the last 12 months if possible. So go watch that. Um and then stable income documentation. So on this level, you are almost always going to be asked to verify your income. Almost, you're from level 0 to level 1. Okay. And then let's go back to the next level. Oh, it's going to take me back all the time, each time. All right. So then now we're on level one, which is the repaired but thin slash subprime credit profiles. Let's talk about that one. Level one. Now, before I begin this one, this is the level that actually inspired this entire live, which is the credit repair trap, because this is the exact level that most people who start to repair their credit, they get stuck at. You get trapped at level one. And that's why I call it a trap, because I wanted to show you and paint the picture fully of how this happens and why this happens. Typically, when you repair your credit or you pay somebody to repair your credit, or even if you did it yourself, most people will get stuck at level one, meaning you have a repair credit profile, so you don't have as many negative accounts that perhaps you once had, right? And so your hard work is paying off. It certainly paid off in a way because you could be at level zero. However, because you don't building in the same way that you prioritize repairing your credit, then you get stuck at level one. So certainly it's better than level zero, but it ain't nearly as good as it could get, is the point. It's still, to me, expensive to be on this level. Okay. So this is the repaired but thin slash subprime profile. This is the risk category for this particular level is unproven borrower. So that just means that you perhaps have started to build credit, show some indicators that, maybe in the future they'll be able to trust you, but because you haven't, your behaviors um haven't solidified themselves enough yet, cuz you perhaps are still in the beginning stages of it, okay? And I also want to note that it's not necessarily, when I say beginning stages, is really as much to do with the timing, um, perhaps more so the experience, the thinness of your profile. Okay, because a person could have one credit card for 5 years, and that 5 years would have passed, but their credit profile is still being labeled as a thin credit profile. Therefore, they cannot surpass level one. Another note before we get into this. Well, let's get into it. What this level, the typical score range for this level is going to be like your 580s to yeah, I put 695 because I've seen 700 credit scores that still are falling onto level one. Right now, um what does this profile or level typically look like? This looks like the credit profiles with maybe 1 to 2 at the most credit cards with very low limits. Not very low, but just low limits. And just for the record, banks consider limits under $1,500 low. Okay, so it does, regardless of where you fall, under or above that, if it's under every credit card that you have that's under 1,500, lenders automatically are saying that's a low credit limit because it is, right? And so this profile will typically have, like I said, 1 to 2 credit cards with low limits, typically like the 500 credit limits, or perhaps like 1,000, right? And then most of the time, everything on your credit profile is new, is under 2 years. And I tell you guys routinely, I tell you guys constantly that when it comes to credit aging, when it comes to maturing, allowing your accounts to mature, any trade line, any account on your credit report that's under 2 years old is considered new to lenders. It's always considered new. It just is. Um, However, when they surpass 2 years, then that's when it goes from a new account to an aged or matured credit profile. Like it's maturing rather. Um, this profile typically will only have limited credit types. I never really see uh a a a a real example on these profiles of a credit mix. Like they're never meeting the credit mix qualification for whatever reason. It's just something that I've noticed. Just picking up on looking at credit reports and going over credit reports is typically on this credit profile, this level one profile, where they're never meeting the quota for credit mix, and that makes me sad because it's just like the only thing that you need to do to get 82.5 points is to have a diversified credit profile. Is to have a credit mix, and that's easy. That's easy to do even with bad credit. So that's why I always tell you guys that even if you have bad credit, that's no excuse to not have credit mix, nor is that any excuse to not be getting your credit utilization points. That's the second and third biggest factor of your credit score. You can still get those with the world's worst credit, you know? Um, that's a whole nother story. Again, your credit limits are typically going to be under $1,500 at this level. Credit 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 on this, or profiles on this level, are typically heavily disputed or include like those missing gaps that I discussed a little bit ago. And then your credit usage patterns, your trended data. If they look back on the last 24 months of your credit card history, they're not able to see a positive incline of your behavior. They typically will see sporadic utilizations or usage that you reporting. Maybe one month you pay the minimum, and then the next month you was over your limit, or it's just sporadic. It's like they can't really decide if you are actually learning, or like really what you're doing. So you are still risky because you're unproven. Whenever your credit profile is thin, anytime, let me back up a few notches. Anytime you have less than 4 active accounts on your credit profile is thin. Doesn't matter how long you've been building credit. Doesn't matter who other credit cards that you are attached to. Meaning, for the people who are piggybacking off someone else's credit card and have authorized user accounts on their credit report, that is not attributed to your borrowing worthiness or borrowing power. That is not attributed. Lenders are literally going to omit that account essentially, and only base your borrowability off of your primary credit, or your primary trade lines, which are accounts that you were approved for in your name solely by yourself. Okay. So because of that, or because of the a ton of people will just lean on trying to buy trade lines or piggyback off mom and dad's account. That's cool for a little boost, but that certainly does not sustain your credit report or your credit profile. It can only take you so far. So if you are not building your own credit profile outside of that trade line, then that trade line is only good for show. That trade line is only good to falsely inflate your credit score so that perhaps you can show your friend or social media, because that's the only people who care or are impressed by a high credit score, right? Lenders are going to look at your report and see that your credit profile is still qualifying for a level 1. So that means that the tier in which they are going to approve you, or the amount that they're going to approve you for, is only within the tier of level 1, which is under $1,500. You know what I'm saying? So it's like it doesn't serve you. It doesn't serve you in a way that you think it serves you if you are not building outside of that. Okay? Um what you can access on this level, you typically will start to have access to starter cards, the mission lanes, the credit ones, some Capital One cards, Discovers, of course, credit unions, the Indigos, in student cards. These are all considered like starter cards. And if you are only approved for like starter cards, that typically means that you're on level 1. Okay. Um, at this stage, you can, of course, get approved for a card. Honestly, you get approved for a car at any level. It's just how much you willing to pay for it. Because I had a 400 credit score and I was getting approved for cars, but I paid for it. I had a 28% interest rate. But at this score, at this stage, you will get approved for car loans, and it's going to be lower than level 0, but it still is going to be, in my opinion, way too expensive. You know what I'm saying? Like even 8 to 15 is high. It just is, right? But I started at 28, so as rich for me to say, you know what I'm saying? Like I started at 28%. So even back then, 8 to 15 would have been incredible to me. But now that I'm on the other side of it and I understand what lenders are looking for and I understand what I could potentially qualify for, now I'm even now 8 to 15 is still even high, just because it's easy to get from level 1 to level 2. It's very easy. Um you typically can get a mortgage at this level too, by the way. You typically can get a mortgage at this level. For the people who like tend to think that like they'll never get approved for a mortgage, I'm like, a mortgage, yes, of course, it's a harder thing to apply and get approved for than like a credit card, of course. But even getting approved for a mortgage isn't the determining factor on if you got good credit, right? Like that. A mortgage, you could get it approved for a mortgage at a level 1, literally. Like you know what I'm saying? So don't let that be the barometer of if you consider yourself to have good credit, because that you have at that point, okay, like you have good enough credit. You got good enough credit to kind of skate by, get by, and get things you want, but you're still paying, you're still doing so at a premium rate. Premium in the negative sense, like you are paying for that in terms of interest, and you are still not getting approved for what you could potentially get approved for if you continue to build and fill in whatever missing piece that you have within your credit profile that's keeping you from the next level. So what's missing to reach level 2, the next level up, is typically, again, you need to have at least 4 accounts in order to not be considered a thin profile. Period. Um and I'm gonna talk about this more when we get to level 2, but just a cheat code. I'm just to tell you guys, the builder's profile that we talked about last week, that I designed around a great building credit efficiently and in the most effective way possible. That builder's profile would get you to level 2. So if you are a person that's tired of being on a hamster wheel and just and tired of the guessing, again, I'm gonna keep saying this because I put the video out for free so anybody could watch it and build credit properly. But that builder's profile will get you to level 2. That'll get you to level 2. If you on level 0 or whatever, and you want to skip levels, I say skip, but you're building in that process. The builder's profile is going to get you at least to level 2. And it's the perfect foundation to build upon to get to 3 and 4 very easily. And it's built that way for a reason, as we discussed last week. So go and watch that video if you have not seen it. I cannot stress that enough. Like literally. Um, so basically what's missing from level 2, the builder's profile. That's really what's missing. Um, and that's just going over pretty much everything that you're missing that we talked about last week. So I don't want to waste too much time on this one right now. But the timeline to get to from like a level 0 or 1 to a level 2 is going to be at least 12 months. Because, like I said, if the second that you have 12 months of perfect payment history, and then including the other things that we discussed, then you are automatically going to go up a tier. So you need at least 12 months of great payment hit, 12 to 24 months, but like let's start with 12 months, and then obviously like continue to pay on time and get to 24 months of perfect payment history. And then you need to make sure that your behavior is consistent. We talked about that last week. Again, I don't want to beat a dead horse with that, but I also still do want to beat a dead horse with it because it is so important. So consistent behavior. Everything shouldn't be sporadic. They should be able to see a linear incline with how you manage debt, how you spend and use on your credit cards, and it doesn't matter what's going on in life or whatever the case may be, you need to still show. And that doesn't mean that you'll never make a mistake and report a high utilization. That's not what that means. If you look at a graph over the course of a time frame, then there is a such thing as, perhaps going up a little bit and maybe going down a little and then going back up. But if you look at it in totality, you will see a gradual increase. And that's all that they care about. And that's all they want to see. Okay. The typical underwriting for level 1 is going to be, you want to start receiving pre-approved offer. You may start receiving pre-approval offers on this level, right? So the second that you go from never ever getting pre-approved offers to starting to receive them in the mail, I still remember what that was like. That was very exciting to me as a person who had bad credit for for a while. Starting to get pre-approved offers, that's super exciting. And it's super exciting because I was just applying for everything. Like I was applying for everything. You shouldn't do that. But the point is, when you start to receive those offers, that is typically an indicator, or that should alert you that you have moved up a level. You're no longer on level 0 if you ever were. You're at least now at level 1. Um, but the biggest difference between the pre-approval offers on this level and the next one is the final approval decisions are not within your pre-approval. Meaning, like, they'll say you're pre-approved and then you apply and then you still get denied. And you're like, what the, like, how did that happen? Well, that was because unless you're at a level 2 or above, your pre-approved offers are not guaranteed. And that's the thing. They're not guaranteed. They're not guaranteed because your credit profile is still considered risky. Way too risky for lenders to some lenders to give you a chance. All right. So, and we'll talk about that. So let me go back to, I hate that I had to keep going back. I thought it was gonna be a little smoother than this, but I'm still learning Notion, so when I be, like, making these, I don't be thinking of the functionality of it, which I probably should. I've been loving Notion, by the way. I've been loving Notion. Alright, so then level 2, again, if you follow the guide of the builder's profile, this is where it's aiming to get you. It's aiming to get you to at least level 2 because that's like the perfect foundation, as I stated. So on level 2, the risk category or your risk level to lenders is going to be there's still a moderate risk, right? Like you're not you haven't completely and totally proved yourself. However, you do show a positive upward trend. That's the whole point of it. That's the whole point of it. And by the way, this does not mean that you don't have any negative accounts. I want to be clear. This are you notice that when we talk about like the what this profile looks like, I'm not even discussing the negative accounts like I did on the previous levels. This level 2, you can't get to level 2 unless you have actively built credit properly and structure your profile according to how lenders want to see it. So, level 2 is the building or builders or intermediate profile. This is going to be the level where, in my opinion, credit starts to get fun. You're able to start enjoying your credit. You're able to start getting the credit limits that you want. You're starting to get the credit limit increases. You're starting to get approved for the cards maybe that you've been looking at for a while with the companies that you have been thinking about, right? So this is to me where your credit, your hard work starts to pay off. And again, I want to say this again. The reason why it like hurts my heart when people are stuck at that level 1 in the credit repair trap is you never even make it to the rainbow at the end of the storm, really. Like all you have made it to is perhaps dry ground. You haven't even experienced the rainbow yet. Like, what was the point of repairing your credit for 10 years or, however long you was repairing your credit and also paying hundreds and hundreds and hundreds of dollars for someone to repair your credit or whatever the case, if you never see it through? You don't even get to benefit off your credit because you're still perpetually stuck at level 1 because you're still just obsessed with repairing and disputing your credit report and not as obsessed with building. And building is the only thing that's going to get you from level 1 to level 2. You can't go past level 1 if you are not willing to build your profile correctly. It doesn't matter what your credit score is. That's the point. Okay. So again, this is going to be the 670s to 740. What does this profile look like? This is going to be the profiles with multiple accounts. So you are showcasing diversity on your credit profile. A lender can pull your credit and clearly see that you understand what credit is, you know how to what it means to be a borrower, you are trustworthy, they can predict with more than a 70% surety that you will not default on this account, whatever they're lending, right? You're not going to default. The likelihood of you defaulting is less than 30%. So that's all it is. This just means that the likelihood of you defaulting is less than 30%. Um, how you get there is you business profile. I feel like I'm keep saying that, but for real, that's facts. But how you get it, just if you want to screenshot it really quick, you have to showcase a mix of accounts. You have to have credit cards plus a loan. You have to have at least 3 to 5 accounts that are open, that are active, including at least one installment account. You have to your average age of your accounts, this is an important one, is at the very least 2 years. Remember what I just said. Unless you've done it for 2 years, it's not ever going to be attributed to you as consistent unless you can do so for at least 2 years or at least 24 months, okay? And also the past 24 months of your credit profile is what lenders are going to evaluate the most. That's what they're really going to determine what you are approved for based on the last 24 months, right? So that's the most important time. That's the time frame in which the trended data that's included in FICO 10T is based off the most recent 24 months. Your total credit limits are typically going to, when you first get to this stage, either be, starting at 1,500, but then you are definitely going to start getting approved for credit cards or credit limits 5,000 or above, which is what's considered like a builder's limit. A builder's limit, meaning again, moderate risk, showing positive upward trend, maybe still not trustworthy enough to have a 20K trade line because you're still at the beginning, you're still proving yourself. From most lenders, obviously you have one-offs and whatever the case, like Navy Federal, they'll definitely approve you for a 20K at probably level 1. But I'm talking about like the major banks and financial institutions. And yeah. On this stage, this person, they keep their balances low. They consistently report low utilization, and they certainly pay more than their minimums on their credit card. That's just not behavior that you're going to see with profiles in level 2. These are going to be the people that is very clear that they're serious about building credit. And even if they had a bad past, because most people in this category will have negative accounts. When I was at this category, I certainly still had accounts that I was not able to get removed. But it didn't keep me on level 1, because the only difference between negative counts on level 2 and negative accounts on level 0 is one includes positive counts, one includes active building, whereas the other one is not concerned about building. And that is the difference. That is the point of this whole live and getting caught in the credit repair trap. Thinking that you need to wait until you repair your credit in order to build credit. That is a lie from the pits of hell. Like, I'm serious. Stop. People are lying to you. They don't care about you. They don't want what's best for you. And maybe they do. Maybe their heart is well meaning, but they don't know what they're talking about. Okay. What was I going to say? Okay, yeah. And so the internal lender markers when it comes to profiles on this category is because you have 24 months of trended data, it shows consistency. It shows that they can count on you to make payments on time, and it will show that your balances are going down. Like, there's a incline in your bad credit behaviors, and there's a decline in your bad credit behaviors, and there's an incline in positive credit behaviors. Your positive actions outweigh your bad actions because it's happened within the most recent 24 months. So again, even if you have bad credit, bad accounts, derogatory accounts, even bankruptcy. If you file bankruptcy within 2 years, you can get to a level 2. Anybody, like, it doesn't matter. Like, there's no certain credit profile that qualifies you in order to start building and getting here at all. It's nothing. The only thing that will unqualify you is the lack of building, you not building. Another one, and I don't want to get caught up on this point because we'll talk about it, I want to say next week, but is the geographic and address stability. And I should have put also employment stability. This is specifically speaking to the personal information on your credit profiles, how many employers you have reporting. You guys already know how I feel about that, which is y'all be reporting too much to the credit bureaus and wonder why y'all be getting denied. If they start to see way too many addresses, your auntie address, your sister, your cousin, your brother address on your credit profile, and it's all been popping up within the last year or two, guess what? Even though this may not be the case in real life, you don't have any geographic stability, which is red flag. Which is, if they don't feel like, I mean, or and that also goes for employers. You every time you get a job, you are reporting it to the credit bureaus. Don't know why you would do that, but you are, right? And so because you have this mass history of switching jobs, and you not ever reporting one job for at least 2 years, then now your income is chaotic and not stable, so they can't count on it. So that also dings you. But people at this level typically will show stability within their geographic and employment on their credit report, the personal information. Whole nother topic. I don't want to get caught off on that. Um Now, what you can access at this level, again, this is when credit starts to get fun. You can enjoy your credit. You are getting approved for the main traditional mainstream credit cards. That's just a short list, but even American Express on this level, American Express approval start at level 2. Just FYI, the gold card requires at least a level 2. Um, I forgot what else I was about to say. So yeah, so most traditional credit card, not traditional, most mainstream or most coveted credit cards will start to approve lenders or consumers at this level, at least level 2. So whenever you apply for the credit, what happens is if I'm American Express and I am offering my gold card, if you apply for this gold card, I'm going to already put within the qualifications of the internal system that the credit profile must meet at least a level 2. So that means that whenever your application comes in and the system evaluates you and places you on one of these levels or tiers, unless your credit profile either meets level 2 or surpasses it, then you are going to automatically be denied regardless of what your score is. And so this is why, as I stated at the beginning, you can have a 750 credit score and still not be, if you can't get approved for American Express Gold Card, and this is just an example because that's the one we're using, then your 750 is empty. It's not even getting you to at least a level 2. And all it requires really score wise to get to a level 2 is about a 660, I think, when I did the math. And by the way, the builder's profile, that's going to get you, like I said, level 2 is going to get you to level 2. But if you do everything that I said and do it consistently, you can at least get a 680 from the builder's profile. And I believe I mentioned that last week, but I wasn't sure if I mentioned like the score, because I don't really like to like tease the score or really focus on the score, because I also don't want you guys to focus on the score, because I just don't want you looking to that as, if you have good credit or not. But because we are talking about it and you understand now, what else goes into it, I want you to know that the builder's profile will get you at least a 680. If you don't have at least a 680 credit score, then you do not have even the bare minimum to build a sustainable profile. And that's with derogatory accounts. Because you can get at least a 680 based on everything except your payment history, meaning that you have room to have bad payment history, bad accounts, collections, and all of that fall under payment history. So there is room that you have, and pretty much all you will need out of payment history is at least 60 of those points in order to get a 680 following the builder's profile. I'm probably not explaining that properly, but those who know and understand fully what I'm saying right now. Literally, just do that, and that's the bare minimum. Um, and so what else I was about to say? Oh yeah, so with on this level, you start to get really good rates when it comes to auto loans. Typically under 8%. I'll be telling people, I tell y'all all the time, over 8% is a no go. Like if they are not trying to approve you for a car loan under 8%, then there is some more work that you need to be doing, unless you like absolutely need the car. But if you could wait and find out what your profile is missing, whatever the case, do that, because car loans over 8% is like it's insane. And by the way, that also works with that also works with refinancing. So if you do have a high APR right now on your current car, if you do, as I've stated, like the builder's profile, you need to ask for you need to refinance your car loan. You need to refinance your car loan at least to under 8%, because that's what your profile will qualify you for. And this is based on national numbers um across car rates. What else I was seeing? Okay, yeah, you see the rest. Like the pre-approvals on this level, as I stated last level, on this level, they typically will come with a guarantee. Like as long as your credit profile has not changed since the lender took a peek at your credit report in order to issue the pre-approval, then you shouldn't have any issue with getting approved for whatever it is. The mortgage pre-approvals, yeah, that's always going to be much easier when it comes to this level. Now, if you are on level, what's this, 2? If you're on level 2, your focus should be, in order to get to level 3, is just continuing to build while also like optimizing the accounts that you already have on your report, meaning continuing those behaviors that we discussed, using AZO method when it comes to your credit cards. Obviously not getting any new collections or charge-offs and things of that nature. Um Ensuring that your income, or not your income, your employer and your address information is stable, and you cleaning off all of the other addresses and employers that's on your report that no longer serve you. So as long this is basically what separates you from this level to the next level is time. That's typically what it is. It's time because, as we discussed, on this level you still have a moderate risk, so you're not completely risk free to lenders. You still have a moderate risk, but you are showing an upward trend. And so to get so level 3 is once you have established. In order for your credit profile to be considered established and to reach a level 3, you have to have at least 5 plus years of established credit history, primary, your accounts that you were approved for, not your mom's, not your dad's, not whoever's, right? Yours. Um you will have at least one, you should, and I don't like using these terms because it's just like, not that you should, but typically, I'll say that when it comes to what separates level 2 and 3 is the credit limits for sure. There's definitely a difference, but your starting rates, your starting credit limits that you're getting approved for should start at around like 15. Like that should you shouldn't really still be I want to be careful how I word this because it's not even that you shouldn't be entertaining. More so, if a lender tries to play in your face and offer you a $5,000 credit line and you have an established credit profile, and I'm talking about level 3, not level 2, then that's where you go back to the drawing board and say, I'm not accepting this and I require at least X amount in order to open this trade line. That's when you start to be able to negotiate with the lenders because you don't pose a risk. They can't validate any reason why you would pose a risk based on your credit profile at that point if you've done it the right way, right? And let me just go to the level. And by the way, the time limit. So the time limit between level 2 and level 3 is typically like 18 to 36 months. That 36-month mark is super, like that's like the golden ticket when it comes to still considered like new, moderate, etc. In order, I mean, to what's considered established and mature. That 36 months. And if you recall from the builder's profile, I told you guys about the short-term installment and the long-term installments and the differences between the two. Well, that 36 months requires at least one long-term installment. You feel me? Are you picking up what I'm putting down? So, but let's go to the next level. Why is it frozen? Okay. So, level 3, which is the prime established credit profiles. Now, if you thought the last level was sweet, this is really where to me it's just sweeter only because it comes with it just comes with that negotiating power. Um, this is something that I will say that I have still not gotten used to this. It's been a few years, but it still surprises me, I guess, how easy companies are to bend when you challenge them and you have the profile to prove it. Right. One time I came on here and it's still on my YouTube channel. I don't even know what it's called. It's probably, I don't know. But I put you guys on the phone or you guys listened in on a conversation that I was having with a lender that it was Golden Sex, the Apple card. Cause I wanted to show you guys how this happens. But the conversation was primarily about like I think at that time, I don't even know that they approved me for I think 15,000 or something like that. I don't even remember the exact numbers, but I wanted to show you guys how to call and negotiate your way to a higher credit limit if your profile is established. And you've seen in real time where they initially approved me for, I'm just going to say 15,000 or so. I actually think it was like 10,000, but so let's just say they initially approved me for 10,000. By the end of the conversation, um, I had gotten off the phone with a $30,000 trade line. That just goes not that I did anything special other than the fact that I recognized the quality of my profile and I was able to um ask them to reconsider that based on, my profile. And so to sum it up, that is the difference between a level 2 and a level 3. Whereas level 2, you still pose the moderate risk. Level 3 is everything but that. This is a low risk. Like less than a 10% chance that the likelihood of you defaulting is less than 10%. That means that you are considered low risk to lenders. They don't have to really be concerned about you defaulting on the account, right? And you are now considered a reliable borrower. And the score ranges from this is typically like the 720s to the 780s. Honestly, with this one, I was really having a hard time with pinpointing a specific score for this one because it's just hard to pinpoint because it's again literally based on just having an established profile, and that just more so is time. But typically, it would accompany at least a 720 plus, all the way up to honestly like an 800 plus. But yeah, So what this profile looks like is you have at least, so I put 5 to 10, but then I was thinking about that earlier and I'm like, it's not five, though five is considered a a thick profile, is the start of what's considered a thick profile. I would actually say 7 to 10, like seven and above, right? Accounts on this state on this level, and you have a balanced credit mix. So you are hitting every tier when it comes to diversification of your credit profile. Your average age of your accounts is over 5 years. That one is so important because the student loan that you want to get rid of that probably contain late payments. My student loans contain 36 late payments. 36 late payments. It is still the longest standing credit line that I have on my credit report because I got it at 18. It was literally my first account. If I were to try to remove that or want that removed just because of from some late payments from however many years ago, do you understand? Like, I would be devastating my average account age on my credit report, which is what is literally probably the beacon of why my credit profile is at least on this level now. From them student loans that I once hated, has all those late payments. You know what I'm saying? Like, it's the point is the credit age that's attached to that account is still serving me more than those late payments affecting me in real time, like in whenever they were affecting me, right? Because you want your average age of accounts to be over 5 years in order to be considered to have an established profile. The total revolving limits, typically the lowest limit on um discounting like the one-off credit cards, whatever, are going to be at the very least $10,000, and then you are going to get approved or see trade lines or credit limits up to about 50K, some higher. Most, depending on the credit cards you're applying for, most will likely not come with a limit, but the ones that do have a limit are going to pretty much cap out at like that 50K, unless it's like business. So this is personal lending. Business is a whole different ballpark, and if you are at least on level 3 on your personal credit profile, don't get me started on what it qualifies you for in terms of business funding, but that's a literal whole nother story because I have an unpopular view when it comes to business credit and how it's typically said to get there or to build business credit. I don't subscribe to that. I don't believe in that, but that's an unpopular opinion. We'll talk about that one day. But anyways, what was I finna, 100% on-time payment history with no recent increase. So, and I'm not referring to I'm not referring to in totality, like that means you've never had a late payment ever in your life. I just told you my student loans have 36 late payments. Um, I just meant 100% on-time payment history is always going to be 100% on-time payment history if at least 36 months has passed and you have not had a late payment. That's just a little tip to anyone. You will let your payment history percentage will go back to 100 if you can get at least to 36 months and not have a late payment. I'm just letting you know. Anyways, what was I about to say? The internal lender markers. So with this credit profile, you should have instant approvals anytime you apply for something. And con- considering that the things that you are applying for is obviously like you specifically want this card, for a good reason. You're not just applying for any and everything. Like, you know what I'm saying? Like, it's just not that. It's, if I want, for example, I'm trying to think of the last card that I applied for. I don't even know. It's actually been a while, but for, let's just say, shoot, American Express comes out with a new card next month or whatever. I don't have any reason to a card like the new American Express card that I would perhaps want. I'm going to specifically apply for that with full assumption that I'm gonna get approved, right? And that's how it should be at this level. Like, you're not really gonna be getting pushback because you are a lender's dream at this level. Very low risk, reliable borrower, experience on their profile, experience with different types of account. You are a lender's dream. And I want to drill that in because I want you to understand that, like, the ball is in your court, but it's not until you get to at least a level 3. It's not until you at least get to level 3. And also, and something else I just thought about, and I need to add on here is the negotiation power goes further than just whether you or what you're approved for or not, like your credit limit. It also goes towards you negotiating interest rates on credit cards, which are extremely high. Every single year that every 12 months that I have with a bank or a lending institution where, my payment history is perfect, my utilization is great, I've clearly showcased, exemplified reliable borrower behavior that full year, I always ask them every single year. I send a letter. I even got a template for it. I didn't. It's in the Credit Academy group. But anyways, every year I'm asking them to lower my interest rate. Every year. Why? I don't even pay interest on my credit card because I don't carry a balance. I don't like paying interest. But even still, even if I had to, um, I still want lower interest. It's just one of the things that I did one time, sort of on accident, because an employee kind of let me in on it. And ever since I did the one time, I'm like, oh, okay. So now I understand that it's possible. Now I understand it's possible. So I'm gonna ask. I'm gonna ask every time. I'm gonna ask every time. And I'll from my experience, I've asked, I don't it's been more than 10 times, but like in terms of different cars and all of that, let's just say 10 times, right? I've only gotten denied once. I've only gotten denied once. Um, because like you would be surprised at how willing lenders are to bend to your request. Again, when you have the credit profile to back it up, because at any point, lenders are hyper aware what your borrowing power is with other institutions, right? And so I always tell you guys, start making them compete for your business. And what I mean by that is you got to understand that whenever a company sees your credit report, the first thing that they're going to do is determine like what other credit products that you've been approved for. Another thing they're going to do is look at your inquiries to see what else you are trying to get approved for. What are you seeking? Have you applied? If I'm American Express, have you applied for a Chase card and a City card, right? Within the last few months, and now you want to apply for us? Okay, if you did apply for them, did you get approved? Is there an account matching that inquiry on your credit report? Quiet as is kept, every inquiry that you have that's not attached to an account is always going to be a red flag to lenders. Like there's always going to ding you down a little bit. Because why were you not approved for the product? And why should they approve you if Chase, for example, is not approving you? But in terms of how you make them compete, when they are looking at all of the rest of your trade lines, on the Apple phone call that I just spoke about, where they instantly gave me an increase even before I agreed to open the account. The reason why they did that is because, as I stated, if you look at my credit profile, you will clearly see that uh I have this card at this limit, this card at this limit, this card at this limit. So you approving me only for a $10,000 credit limit is a waste of my time. Why on earth would I even entertain the idea of opening an entire new account on my credit profile, losing credit age, because every time you open an account, you're gonna lose a bit of your average credit age for a $10,000 trade line when American Express is giving me this and is certainly willing to give me more. As you can see, based on the history of this account, this credit limit started at this amount and it's now at this amount. So there's a clear progression of this credit limit on multiple accounts. There is no reason in any stretch of the imagination on why you believe that I should even entertain the idea of opening a $10,000 trade line, right? And so that's what, like, you literally are. It just makes credit a lot easier. It makes credit a lot easier, and then you stop looking at lenders as like vultures, and you look at them like tools that you can use in order to get whatever you're trying to get or get to wherever you're trying to go. Now you are understanding, like, you really start to see how to not allow credit to use you, and the inverse happens. You are not even entertaining a product unless it is going to add to whatever you have going on. You're not ever applying from a desperate place anymore. Like it, because I've been on both sides of it. I definitely know how it feels to just want to apply for anything and get approved for anything just because, child, ain't nobody else approving me and I need something. I know how that feel very well. Long for longer for I knew how that felt longer than I now know what the other side feels like, right? So it just really does change your entire lens when it comes to credit. And you start to really understand why, no matter what individual's net worth is, why they will still tell you that cash is cool and credit is king. I used to be like, that's a stupid ass saying. Like, it's easy for you to say because you're a multi-millionaire, a billionaire, whatever the case. Like, that's very easy for you to say. But then understand now. Now I understand what they mean when they say that. And essentially, the whole ideal is just your credit will always or should always be able to make it m- make you be able to amass more capital. Whether that is you wanting to get a business funding to fund this new business venture that you have or this idea, whatever the case. When I first started angel investing, I did so off the back of my credit. I didn't have liquid. I didn't have enough liquid cash in order to like invest how I do now or even how I did if it were not for my credit. My credit was able to give me loans, and I'm not giving advice, by the way, because I still kind of go back and forth on, if this risk was smart, but it paid off, thank God. I literally would take a personal loan and invest in this business. Thank God it paid off. Because let me be clear, that's why I would say I'm not giving advice. Because again, I be a little crazy sometimes, but it worked. And I wouldn't if it were not for my credit, I would not ever have been able to do that. Like ever, I would have never been. I'm not gonna say I would have never. Well, I likely would have never had enough money, liquid cash at that point, in order to make 60% of the investments that I made in the beginning, because it was literally all off personal loans. It's crazy. That's actually crazy saying it out loud because I definitely don't recommend that. But you get what I'm saying. Um, did I just go over this? Oh, that was for the last one. Yeah, so obviously the premium credit cards, the limits, all the bells and whistles. Like it's very clear. Obviously, at this level, you get more than what you have gotten at the past levels, and so it just is easier. Credit is easier. Like it just is smooth selling at this point, and all you have to do is just continue to do what you're doing, and like that's it. That's it. That's it. Um, and then level 4 is the last level profiles and how they're like categorized or graded by lenders. And level 4, strategic wealth profiles. Level, obviously the risk category is like extremely low. If anything is like less than I think I read like 5% or something like or maybe 3%. I don't know. It's very low, right? And then you have a high asset value, a high asset value. So that's what separates this tier to from the previous tier. So it's not even the score or even honestly the credit profiles that you I mean the accounts that you have on your credit report. What separates this tier from the last one is your high asset value. Your high asset value. Um and so this is where like obviously like the multimillionaires, the billionaires, they're typically going if they build credit because I can't tell you how many rich people that I've dealt with that don't have good credit because they've never had the need to build credit. And so when they come to me, it's like, you got to get this credit bidder loan and you have to get this $25 loan and pay it every month. Don't pay it off early. And that is very hard for them. But if you have wealth and you have great credit profile and the two mesh, then you now get to the elite level of credit in level 4. And this is where like credit building is only about strategy. It's only about strategy. It's only about strategy. Um, this is going to be the complex credit profiles, and obviously you will have multiple banks and all of that. Most of your credit lines are going to start at like 75K. You definitely have at least 10 years of experience with major milestones, and major milestones includes having a mortgage reporting. So you would have had to at least have a mortgage in order to get to this level. um you definitely are going to be venturing into the business, or not venturing into, you typically would have business credit on this level, even with the same institutions that you have personal credit with. um Consistent 1 to 5 utilization, 1 to 5% utilization, as I told you guys last live. Definitely multiple open installment accounts. That's usually what you see on high network individuals. Credit profiles is multiple high limit installment accounts because they are typically like, for example, I had a was he a firm? He was some sort of doctor, and he was opening like a practice, like a like a practice or whatever. And he would be who I consider in this category based on his credit profile, but also because like his asset value. And on his credit profile, one of the things that I just found very interesting was like, I was like, dang, this is some rich people. Like he had, I want to say maybe like four loans from Range Rover, like on his within like the last year on his credit profile. He had multiple properties. um it's just a different story. Like, like it just was different. I was like, oh, this different. Like, oh, like it was very interesting to me. I love to see just what rich people finance. Like, I don't know, it's just always interesting to me. What are rich people financing? A person who has the money, the liquid to buy anything outright, is interesting to see what they finance. And it's typically installments. Obviously, they'll have the credit cards, but those, whatever. It really be the installments for me, because it'd be like, wow, to have multiple $100,000 installment loan account, like multiple hundred thousand plus installment loans on your credit profile. Oh, you got some money. Like, you got some money. But yeah, it's just interesting to me. They're going to be the ones with the private banks, all of that, all of that. They definitely are. Oh, by the way, so while I did want to mention this though, we talk about the invitation only cards a lot, like the Centurions, the Reserves, and all of that some companies will offer, or they don't offer it because you can't just apply for it. You have to be invited to apply for it. You typically have to have at least a level 4 credit profile in order to qualify for American Express, for example, to send you an invitation to the Black Card. For JP Morgan to send you an invitation to their card. And it's multiple banks that offer invitation only cards, but typically, so sometimes you can get invited on a level 3, but you have to have be spending a lot of money. But for the most part, it's level 4s that get those invitation only cards and all of that. Um Definitely investment properties and just investing in general is very heavy on this tier. So when I was talking about my experience and how I started, I'm in an investment group with very experienced investors, and I remember one of them had mentioned like this is what they use their credit for. And child, I didn't know nothing about tiers at that point, but I knew I had good credit I was building, and so I had started doing it ignorantly. We thank God for His grace, because again, I that could have been went very wrong, but he was the first person that planted the seed on using credit for investing. I had never heard of that concept in a way that like one of my investment partners had explained it to me, that he was doing it. And so that led to me doing it. But y- that just I say all that to say that like on this level, and when it comes to like strategically building credit and wealth profiles, it's strategic in that it's on the only cause really for their credit profiles is to invest into is to increase their investments, which is in turn will increase their net worth. And so yeah, like that's just a little story, because that's how I got started. And it's funny to me now because child, people be like, can you tell me how to get into an angel investment? It's like always a gulp in my throat, because I'm like, if I tell you what I did, like I would have to be responsible for however it turned out to you, and I'm gonna feel bad. So I can't tell you in good faith how, because I didn't do it the traditional way. So your focus on this level just for framework purposes, and I wanted to include the same outputs for each. Your focus at this level is do continue doing what you're doing, because I or no one else can tell you what to do, because clearly you know what you're doing if you're at this level, you know. But yeah, your focus definitely should just be to utilize your credit as strategically as possible to increase your net worth, in my opinion, at this level. Because what would be the point if you're already a high net worth individual? Credit could only add to either furthering that, but you're not relying on credit. You know what I'm saying? So it's just like continue doing what you're doing. Um, yeah, and then wait, it was something else I wanted to show you guys how long we've been live. I said an hour. It's been 2. Okay, I'm gonna end this. But now, your parting strategy. This is what I wanted to get to. Your parting strategy. Um, I just seen a question and I'm gonna ask you guys. And if you know the answer, please leave it in the comments because I'm wondering this too. I build these lesson plans sort of say out in Notion. I use Notion. I'm still new to Notion. Is there a way that I can like make it publicly available for you guys to be able to access this, but not access my full Notion library? Cause like that's like dang near my lifeline for the past few months. But I want to be able to like share these with you guys without showing you or showing like, you know what I'm saying, exposing my entire Notion. So if you know the answer to that, leave it out, leave it in the comment section, please, please, please. Because I'm more than willing to like make this available for you guys. But anyways, your parting strategy for today is to rewatch or watch for the first time the part 1 video or the last video, which is titled A Complete Guide to Building Credit Without the Guesswork or Gimmicks. It's on my YouTube channel, Shonda Martin. Watch that so you understand how to build your profile exactly from where you are right now. And then follow the builder's profile checklist, which is included in the video and also, yeah. And then you need to identify what level you are currently on. As a matter of fact, while I'm here, what level do you feel as though you are most likely on? What tier? Level 0, damage derogatory. Level 1, repair but thin. Level 2, building but intermediate. Level 3, prime and established. And then level 4, strategic and wealth. 1, 0, 0. Okay. And that's real. So the great news about that is if you are on level 1, if you are on level 0 or level 1, I can get you to at least level 2. I could get you to at least level 2 without not much output on your behalf other than literally just following directions, right? And I can get you to level at least level 2 within 12 months. Okay? If you are on, I see a lot of 2s and 3s. So if you're already on level 2 and you're trying to get to level 3, then after you identify the level that you are on, each one, that's why I need to make this available because I put the section at the bottom where if you, in order to get to the next level, these are the things that you're missing. Can you show the what you're missing on each level? Yes. Let me just show that really quick before I get out of here. All right. So, oh, actually, I did. I was gonna say I thought I. Okay, right here. So just screenshot this. I'm gonna scroll down. Screenshot this. I'm gonna give you guys like 10 seconds to screenshot this, and I'll scroll down. So if you are on level 0 currently and you're trying to get to level 1, this is what you need to do. Here's a list of things that you need to do. Still need to watch the video for sure, but these are the things you need to do. And then so actually screenshot that. This would have been it would be so much easier if you guys can have access to this. And it's like when I be building them out, I'm like, wait, can I download this as a PDF? Oh, wait, hold up. Oh. Oh, okay. So look, I didn't even realize that you can download it as PDF. What I'm gonna do in the description of this video on YouTube, I will include a Google Drive link to download this PDF just so you guys, I won't have to continue to scroll down and you guys, you know, can't see it. I'm gonna also go back to the builder's profile video and also make this one available for you guys to download because this one is where all the information is on how to build your credit step by step and all of that. Okay. So I will put both of these in the download in the description portion of both videos on YouTube. And by the way, just let me show you guys. Oh, child. I don't even know what I typed. I tried to type in Shonda Martin. All right. So if you go to my YouTube channel, I think it's going to start playing. Watch this video. which is a complete guide to building credit without the guessworks or gimmicks. It was 7 days ago. Go watch that for how a step by step process, eliminating all of the guesswork, all of the gimmicks, all of the chase. Literally telling you exactly what to do from scratch or from wherever you are in your credit process. What you need to do to at least get a builder's profile, aka a level 2 credit profile, without you having to even guess anything, literally. So watch that video, get a notepad, and just again, just jot down whatever the recommendations on that video, and then I'll make the Notion page or the PDF available in the description after this video loads. So it'll be in both, okay? Including the one that we went over today. All right. Um yes, and this will also be available for replay, okay? So put a gem in the comments if you learned at least one thing today, or yeah, put a gem in the comment if you learned at least one thing today, and then put a fire in the comments if you were able to identify what level you're on, and you know your scope of what you need to do in order to get to the next level. Do we have anybody on level 5? I just feel like you, yeah, I wouldn't say it if you was, but like that would be cool. A gem of fire. Okay. Praise God. Okay. Yeah, so next week's live, I don't know exactly what it's going to be over, but I do know it's going to build on this. I don't know what it's going to be titled rather, but it's two concepts that I'm battling on presenting next that's going to build upon these the things that we talked about today, and just to further increase our understanding of credit and what it means to have good credit and build credit. Um yeah, so I will see you guys on the next live. Credit Academy members, VIP members, we will have a Q&A, a live Q&A on Monday or on Tuesday. Sorry, Tuesday. And you guys can come up and ask me questions on the phone, or like you can come up or you can type it in the comments. Either way. So we'll do one of those. We'll do those live credit consults. And then yeah, I will see you guys on the next live. And again, go back, watch the previous lives, rewatch this live, and build your credit. Stop letting people lie to you. Stop letting people charge you all that money to get you nowhere. Build your credit. Nobody can do that for you except you. Okay. All right. I love you guys. I will see you guys later. I hope you have an amazing night and an amazing weekend. And God bless you guys. All right. Bye bye.